Beginning your investment journey is like setting a snowball rolling downhill, gathering size and speed as it goes, thanks to the power of compounding interest. But before diving into investments, grasp a few fundamental rules. These rules form the bedrock of a successful investment strategy, safeguarding your money and ensuring it grows steadily. Let's uncover these crucial principles, laying the groundwork for your financial success with compounding. Adjust your risk tolerance. If you're just starting to invest, it's really important to think about how much risk you're okay with. When you're in your 20s, you're often in a great spot to try out investments that are a bit riskier. Why? Because you usually don't have as many big responsibilities like a big house loan or a bunch of family expenses. This means you can go for investments that might be a bit daring but could also lead to big growth. Remember, every time you pick one investment, you're missing out on what another one could have given you. This isn't just about how much money you might make, but also what you could learn and how you could grow from different types of investments. Taking calculated risks is super important. Don't just jump into something because it's popular or seems exciting. Do your homework, keep an eye on what's happening in the market, and maybe even talk to a financial expert. It's all about finding a balance. You want a mix of investments that fit your long-term money goals, but also leave some space for more exciting choices. Automate your investments. If you're new to investing, setting up your investments to happen automatically is a really smart move. It's like putting your investment plan on autopilot. Imagine it's like having a part of your paycheck automatically go into a savings account, but this time it's going into your investments. For example, you could have a bit of your money automatically put into something like an S&P 500 index fund every month. This kind of fund invests your money across 500 big companies in the US, so you're spreading your bets across lots of successful businesses. Here's a super important tip. Don't try to beat the market. Guessing the best time to buy and sell is super hard. Even the pros struggle with it. It's much smarter to focus on growing your money over time. That's where ETFs or exchange-traded funds come in. They're like a mix of different stocks or bonds in one package, which helps spread out your risk. Tools like InvestEngine are great for this. They make it easy to get into ETFs for the long haul, and they offer special discounts like ISAs that can save you on taxes. You set things up once on these platforms and they handle the rest. Your money gets invested automatically. This way, you're not making emotional decisions about your money. You're steadily building wealth over the long run. Avoid temptation. If you're new to investing, here's a key tip. Be careful about jumping into risky investments without really knowing what you're getting into. This is especially true for stuff like penny stocks or cryptocurrencies. Sure, you might hear stories about people making loads of money overnight, but these kinds of investments can be super shaky and you could end up losing a lot. It's good to listen to your gut feelings, but don't just rely on them. Make sure you do your homework on any investment. Learn about different ways to invest, keep an eye on what's happening in the market, and don't be shy about asking for advice from people who know their stuff. Also, watch out for quick money solutions like payday loans. They might seem helpful at first, but they can trap you in a cycle of debt that's hard to break out of. These loans have crazy high interest rates, and before you know it, you owe way more than you borrowed. This can mess up your finances big time and make it hard to save or invest your money. And now, when it comes to a serious investment strategy, you should familiarize yourself with compounding interest. It's like a snowball rolling downhill. The longer it rolls, the bigger it gets. It's the process where you earn interest on your initial investment, and then you earn interest on that interest, creating a snowball effect. For example, if you invest $1,000 at 5% annual interest rate, in the first year, you earn $50 in interest. In the second year, you earn interest on $1,500, not just your original $1,000. Over time, this adds up significantly. Now that we understand the power of compounding interest, let's explore some good investment assets that benefit from this phenomenon. Dividend-paying stocks. Investing in stocks that pay dividends is a really handy move for anyone, whether you're just starting out or have been investing for years. Basically, these are stocks from companies that give back a part of their profits to you, the shareholder, as dividends. It's like getting a regular paycheck from your investment. Plus, if the company does well and its stock price goes up, you can make even more money. Here's the deal: when you buy these stocks, you're grabbing a piece of the company's earnings. This is great if you want a steady flow of cash without doing much. And if the stock price climbs, you get a bonus in the form of increased value. But picking these stocks isn't just a random choice. You need to be smart about it. Look at how much the company pays in dividends compared to its stock price. That's the dividend yield. A bigger yield might mean more money, but make sure the company isn't paying out too much of its profits. That's the payout ratio. Also, check if the company is in good financial shape to keep paying dividends. Let's say you put $100,000 into these dividend stocks and they have a 3% yield. You could get about $3,000 every year from dividends alone. Plus, if the stock value goes up, your investment grows even more. Real estate investments. Investing in rental properties is a really solid move if you're looking to add something different to your investments. The cool thing about rental properties is that they can give you a steady income every month, kind of like getting a regular paycheck, but from your property. It's different from stocks or bonds because you actually own something physical that people pay you to use. Not only do you get money every month from rent, but the actual value of the property might go up over time. So if you decide to sell it later, it could be worth a lot more than when you bought it. A smart move is to use the money you get from rent to make the property even better, paying off the loan quicker, or even buy more properties. This way, your money keeps growing. For instance, say you buy a place and only pay 20% of the price up front. Fast forward 20 years, and not only could the property be worth way more, but all the rent you've collected adds up too. If you use that rent money wisely, like buying more properties or fixing up the one you have, you could end up making a lot more than what you initially put in. Just remember, picking the right property is key. You've got to think about where it is, what kind of place it is, and what's going on in the market. But if you get it right and stick with it for the long haul, real estate can be a great way to boost your wealth and financial security. Precious metals. Putting some of your money into precious metals like gold and silver is a pretty smart idea, especially if you're worried about things like rising prices, that's inflation, and the ups and downs of the stock market. Gold and silver have been valuable for a long time and usually keep their worth even when other investments are doing poorly. They're not like stocks or houses though. They won't pay you a regular income like dividends or rent. But over time, the value of these metals usually goes up, which can be really good for your overall investment mix. One of the biggest things about gold and silver is that they're like a safety net. When the stock market gets crazy or prices start to jump up, inflation, gold and silver often get more valuable. They're kind of like an insurance policy for your money. They might not make you rich quick, but they can keep your investments steady and safe. Say you've got $500,000 to invest. Putting 10%, which is $50,000, into gold and silver is a smart move. It's not so much that it will take over your whole investment plan, but it's enough to give you some protection. Over a lot of years, this part of your investments could grow quite a bit, especially when other things you've invested in aren't doing as well. Remember, investing in gold and silver is a good idea, but it shouldn't be the only thing you do with your money. If you only invest in these metals, you might miss out on the chance to make more money with other types of investments. But as part of a mix of different investments, they can help keep your money safe from big market changes and rising prices. Index funds and ETFs. A really good way to start investing, especially if you're new to it, is to put your money into index funds. These are like big baskets of stocks or bonds that copy what's going on in major stock markets like the S&P 500 or Nasdaq. By investing in an index fund, you're basically spreading your money across lots of different companies. This is great because it means you're not just relying on one company to do well. It's like not putting all your eggs in one basket. A cool thing to do with index funds is to keep adding a bit of money to them regularly, which you can even set up to happen on its own. Also, if these funds pay out dividends, that's a share of the profits, you can use those dividends to buy more of the fund. This is where the magic of compounding comes in. Compounding is when you make money from your investment and then that money makes more money and it keeps going like that. Let's say you put $20,000 into an index fund and it gets a 7% return each year on average. after 20 years, without putting in any extra money, that $20,000 could grow a lot because of compounding. It could more than double. Bonds. Bonds are a good choice if you want a safer kind of investment, especially compared to the ups and downs of the stock market. Think of a bond like giving a loan to a company or the government. In return, they'll pay you back with interest. This interest is usually paid on a regular schedule, which means you can get a steady flow of money. This can be really helpful if you need to count on getting a certain amount of money regularly, like if you're retired. One big plus with bonds is that they pay you interest steadily. With stocks, the money you might get, called dividends, can go up and down depending on how the company is doing. But with bonds, the interest payments are usually set at a fixed rate, so you know what to expect. Another smart move is to take the interest you earn from bonds and reinvest it back into more bonds. This can really grow your investment because of compounding, which is like earning interest on your interest. For example, say you put $100,000 into a bond that pays 5% interest every year. Over 10 years, if you keep reinvesting the interest you earn, your investment can grow a lot because of this compounding effect.